There's one of two classes. They're either not a serious seller, right? Because there's people testing the market, or they have to sell. You either fall in one of those two classes. It's no longer like oh, I'm a logical seller that's going to be going into the market expecting a logical price back based on the market conditions. It's not that anymore. It's you're either needing to sell or you are not a serious seller at all. So if you're not a serious seller at all and you're living back 3 years ago in terms of prices or 4 years ago in terms of prices, you're sitting on the market for 120, 180, 365 days. But if you have to sell, like that right there is, I think right now where a lot of investors, if you're not scared of buying, a lot of our clients are finding good deals in that distressed market because they have to sell. And I think that's where the money is right now.
How does a broke single mom fired from Denny's go on to become America's most sought after real estate investor? Well, that's why we have the most wonderful real estate podcast ever. Our motto for 26 is stack gold bricks in 26. I'm going to teach and share and bring you all kinds of great guests for season 8 in 2026. And we're going to learn how to stack gold bricks in 26. So you want money? We're going to get it. You want health and wisdom? We're going to get it. You want to learn everything there is to know about real estate investing? It's here. The most wonderful real estate podcast ever. Now on to the show. Hey everybody, welcome to the most wonderful real estate podcast ever. I'm your host, Dwan Twyford. I am America's most sought after real estate investor, and I'm really excited that you are here with me today. So I took the name Dwan and the word wonderful and made Dwanderful. But that's how we became the Dwanderful universe. So if you're not already following me, go to Dwanderful.com, D-W-A-N, Dwan, DERFUL.com, Dwanderful.com, and opt in, take my real estate investing quiz. And if you take the quiz and fill the form out, I'll have a 30-minute conversation with you, just me and you, one-on-one. No pressure, no strings, no nothing. And we'll just talk about what it is you are doing in your real estate career and what you want to do and where you want to go. You can find me on all socials. Just type in Dwanderful. I'm on everything, everywhere under Dwanderful. So I'm super excited to have a guest today. He is so adorable. We've been talking for a few minutes before we started on today. So this is Jonathan Yoo. So Jonathan, how are you today?
I'm great. Thank you so much for having us on.
Yeah, I'm really excited you guys are here today. He's from Korea, so I was telling him about my visit when I took Bill and I took all the kids that went to Korea and stayed for, I don't know, like 3 weeks. We had the best time. And so what I like to do, Jonathan, is I actually just kind of throw my guests to the wolves. I want you to just tell us briefly your name, how to find you on all of your social medias, and the name of your company, or what you do, but like in just a couple sentences. And then I'm going to ask you some questions. So we want to know, what's your deal?
So my name's Jonathan. I started Convoy about almost 6 years now ago. And we've grown to become, in terms of the DSCR, well, probably the biggest DSCR broker in the nation. For non-conventional loans in general, we're the second largest in the nation. And the reason I specify non-conventional is because in 2021, 2020, think back to that time when rates were 1%, 2%, at the high of 3%. My partner and I, Dustin, who's supposed to be here, imagine, he's we started the company and we said we got to niche ourselves into something else because investors are really underserved. And so what we did was we were one of the first brokers to actually bring these non-conventional market loans to market. So DSCR, bank statement, profit and loss, those types of loans, and do them on a massive scale. And we essentially didn't do as much conventional and we swayed towards the investors. So we specifically dug our heels into the investor channel and the luxury channel. And that's kind of how we've built our business up until this point. And yeah, so now we're
socials. How do we find you?
So go.
How you got there?
Yeah, so you can find us on the App Store and also Google Play Store. If you just look up Convoy Home Loans, it's on there. If you look up Convoy Home Loans on Instagram, Convoy_Home Loans, you're going to see us pop up as well. But I think the easiest way to get a hold of us and find us is probably the Google Play Store or App Store. Or if you just Google Convoy Home Loans, we're probably the first one that pops up. Yeah.
That's nice. That's nice.
Yeah.
So, well, good for you guys. And so, what I do like is that you said you work more towards investors. So, and I do like that because I feel like, anyone that's trying to be an investor or fix up houses or buy commercial or anything like that, I feel like they really are underserved because there's just so many like lenders out there, but not really that specifically lend to within to investing. So when you guys say like you gear towards investors, like in what area? Like what do you do? I want to borrow money and I'm an investor. What am I doing?
So there's a lot of misconceptions on non-conventional loans, saying that they're potentially higher rates or less inferior terms to like conventional type loans that the banks will give. Because we do so much volume as it is right now, a lot of the lenders that we work with and a lot of the funds, like Wall Street hedge funds that we work with, will take a less margin on their rates. So actually the rates that we have sometimes are actually better than conventional loans. And sometimes they're actually at least at matching with what conventional is right now. And it allows investors not to have to provide tax returns or all the normal stuff that you would have to provide and just be able to qualify on the asset itself, just focus on that, but not have to worry about getting terms that are worse than what, for example, banks are giving or other conventional lenders might be giving. And the beauty with us actually is we have the conventional loan world. Like we've been doing that for 10 plus years. So conventional, if you want to go that way or if someone wants to go that way, we can do that as well. But if you don't want to go that way, you want to for sure put it into an LLC because people don't talk about it enough, but conventional, you're not supposed to put it into an LLC, right? That's not how the loans are written. It's actually in your loan documentation that you're not supposed to be changing out vesting that way into another entity. DSCR or the non-conventional world allows you to close directly into the LLC or the S Corp or the C Corp, whatever entity you're trying to close in. And all you do is sign loan documents as a member or manager of that LLC. The personal guarantee aspect of it, if it's a residential property in most cases, but that allows you to really take advantage of having it separated into the LLC or an entity versus in your personal name.
No, I know. The banks will never let you close into an LLC.
Yeah. They usually want you to do something like the loan officers, obviously, what they'll tell you is, oh, just close in your personal name and then switch it over later, right? But technically speaking, that's if you look at the loan documents that you sign with are like 1,000 pages, right? But if you actually go through the 1,000-page loan document, you'll see that you're not supposed to be changing vesting to an LLC or another entity that's not you as an individual after closing. Now, the chances of you getting audited and you getting caught might be slim, right? It's never zero, might be slim. But I think I've been seeing it more happen now than before because now these servicers, which are the people that buy the notes and service the notes, get your payments, send out payments, they are starting to utilize AI, right? And with AI, they're starting to see which titles are actually held by the original borrower, which aren't. So subject to, which is you kind of been a massive wave of people trying to buy properties, subject to properties, right? Wraparound notes. Like some of those people I've been speaking to having issues because their bank sent them a notice saying that you can't do what you're doing right now. And you either need to sell the property or refinance it out. And so
you on sale clause?
I've been seeing more of those happen. And again,
I've never seen that happen yet, but I'm starting to.
They are. And it's actually happening more often in the last 12 months than I've seen ever in the last, 10 years in business. And I think the reason why is, again, the power of AI, right? These servicers are not dumb, right? They might be a little blind, right? They might not have 20/20 vision, but they're not dumb. So they are now utilizing AI, and a lot of the servicers that we've been talking to, they know what's going on, right? It's just more of a matter of, is it worth for them to actually go after them or not, right? But they know what's going on. So that AI tool is really coming into play there. So if you want to do things correctly, right, the first time, that's why a lot of investors are shifting over to this product versus just going conventional.
Yeah, no, I agree because it's funny because when I teach my 2-day workshops, I teach a session on subject two. The subject two is like a great way.
Yeah.
Rentals that people feed the house to you, you take it over, you rent it, or I like to sell them owner financing, like just whatever. It's a really great way to help someone get out of their loan, get them some money, get them moved out, get their payments back current, and do a subject two. And every time, I mean, for 20 years, people go, what about the due on sale clause? It's always the first question out of everybody's mouth. I'm like, honey, I've never in 20 years seen anyone call due on sale clause. I said, now I'm going to have to keep in mind that things are changing a little bit.
Yeah, but if you're doing it the right, I think there's a right way to do it and the wrong way to do it, right? Some people will just change on title and just make the payments to the person instead of creating, any other note or any other form of, title vesting, whatnot that needs to be done for trail, right? That typically allows for a little bit more of a leeway situation. I don't want to say it always does because, again, like these documents that people are signing that they don't read, right? Thousands of pages on loan documents. They think it's a great idea to do subject to. And a lot of times, like you said, it's a great way to acquire real estate. However, the only problem right now that people are running into now that I'm seeing is AI, right? So people are like these servicing companies, they've invested a lot of money into AI. They see what's going on. They're tracking the trends and, record keeping and all of that. So that's just a word of caution, right? Going forward. I don't, again, there's never 100% guarantee that, something's going to happen one way or the other. If someone might, and people might come out and say, I've had a, subject to for 40 years and I've never had any problems, like, good on you. But it doesn't mean it.
You can't say 100% anymore.
Yeah, it's not there.
You can't say 100% anymore. And with AI can go through documents and read documents and go through all the things that like a human really couldn't do.
Yeah.
There's a stack and nobody signs up. So you guys are doing sort of like hard money lending. Is that what it is?
No, I mean, we do a little bit of that too for fix and flip type stuff, but the majority of the loans that we try to focus on because we do so much volume, a lot of our lenders and a lot of the Wall Street hedge funds will securitize our debt and then sell it. So we focus more so on like right now, I would say about 80% of the volume we do is DSCR, like debt service coverage ratio loans, and bank statement and profit and loss, like self-employed. Yeah. So debt service coverage ratio, which is probably, I think, the best product that's come out for investors in ever, right? It existed for forever in the commercial world. Right. So commercial, anything over 4 units is considered commercial, or mixed use properties with retail and residential are considered commercial. Those properties have had DSCR for however long. Right now, 5-6 years ago, DSCR started rolling out for residential properties, 1 to 4 units. And with those 1 to 4 units, DSCR came out. Now you can qualify based on just the rental income of the property. But the underwriting is actually a lot simpler. So commercial properties will take an expense ratio, they'll take vacancies, they'll take, management fees, all that stuff off of it and calculate your debt coverage ratio off the NOI, which is the net operating income. Mm-hmm. On residential, they don't do that. They'll take it off the gross. So it'll be gross income and then compared against your principal, interest, tax, and insurance. And if you have association dues. And that's it. As long as it covers on that scale, on that number, at least at 100%, you're going to get good terms. If it's below 100% on the coverage, right, you have to mess with it a little bit. If you can't get it over 100%, then you could still close on it, but it won't be the better terms that, for example, 100% coverage or even above that would end up being.
No, I like that. Yeah. So what do you guys like to lend on? Like, what's your favorite area? Do you lend on, if I want to do like a rehab, or there's short-term loans for rehabbing? If I want to buy a duplex, a triplex, if I want to buy a building or a mixed use building, like where's your happy spot?
So we operate in all 50 states. So geographically, there's no restrictions, but in terms of property type, like I think you're going to get the best terms on 1 to 4 units, right? Whether that be a condo, single family, or townhouse as the single unit, up to 4 units, because then you can confidently get 30-year fixed financing, because a lot of commercial financing, if you want lower rates, typically ends up being like 3-year, 5-year, 7-year fixed, which unfortunately, and this is actually the perfect time to talk about this, right? Because if you look in just look right now, right where we are, 2026. Anyone that got into a 5-year fixed arm for a 2% back in 2021 is now having to refinance, and a lot of people are having to put money into refinance, or they are not able to refinance at all, and they're having to sell, right? So I'm sure you've seen, like, Brandon Turner's a huge name, right, in the real estate investment community. He recently had just released, a statement saying that, he lost $15 million on a property, right, selling it. And he publicized that on Twitter or X, I mean, and on Instagram. And the reason, one of the points that he put in there is buy time on your side, because he had bought the debt with, like, I think 3-year or 4-year financing. And that is true today, I think, more than ever, because with the market, we kind of talked before we got hopped on camera, but the market is kind of in probably the most tumultuous stage we've seen since, like, COVID.
Talk about that. Let's talk about that. But
Yeah.
not that. Wait. Let's talk about that on the show.
Yeah.
I agree with that.
Yeah. So, like, if mortgage rates for the residential properties, especially 30-year fixed debt, is typically tied to longer term treasuries, right? Is how you can track whether mortgage rates are going up or down. The 10-year treasury today, and even a couple of days ago when it was at its highest point, we're basically at the same treasury levels that we were at back in 2006, 2007. Mm-hmm. And if you remember 2006, 2007, going into 2008, like, we're talking about an increase and then a crash, right? So I think the market is telling us something, and people are so obsessed with mortgage rates and the federal funds reserve rate, and kind of how stocks are hitting all-time highs. They're not really looking at bonds, but where smart money is really looking, and where these hedge funds are looking, and where everyone's kind of forecasting, is the bond market, right? How much of a premium is it to trade that debt right now on the market, right? Are they having to increase yields to try to coerce investors to buy bonds, right? That's kind of like where people have to be looking, I think, right now, especially in this market versus any other market. Stock market, can't believe it, right? We're hitting all-time highs when employment is supposedly okay, but I'm seeing my peers left and right looking for jobs, right? Housing is supposedly strong and supposedly not having that many defaults, but we're seeing defaults still increase on a year-to-year basis, right? Inflation, right, is seemingly supposedly under control, but we're recently finding out in the last 2 months it's not under control. Inflation's starting to go out of control. So all these things are kind of playing into the factor of, now the feds are trying to, like, Kevin Warsh, the new Fed chair, is going to change. He wants to change the way that we see inflation, right? So instead of taking month-to-month inflation with CPI, PPI, all those data points, he wants to do a trend. And the trend is going to change the way that the feds make decisions on their federal funds rate, what they are planning on and forecasting. And that in itself could be a little bit of an issue, right? Depending on how the bonds are looking at it. And the bond market, it doesn't like uncertainty, doesn't like inflation, right? Inflation is the number one enemy of the market, because inflation makes everything more expensive. And that's kind of where we are right now. Yeah. We're in that point of time where everything's becoming more inflationary. So I don't think there's a way to avoid that. So again, going back to why time is so important, if you have a 30-year fixed debt versus a 5-year fixed or a 3-year fixed, right? Unless you're really truly planning to exit the market in 3 or 5 years, like, you can no longer get into a loan on a 3 or a 5-year fixed and expect to refinance for anything better or less in the current market.
Yeah, no,
because,
I agree. That happened back in, like you were talking about 6, 7, 8, that big giant crash. People don't understand, like, well, why did everything crash? It's because all these people were refinancing their house for, remember the commercials? Well, I don't know. You're pretty young. You might not remember the commercials. They would say, refinance your house for 125% of its value. Do add-ons, do garage, do this, do that, da-da-da. And they were interest only. And people got like 3 and 5-year interest only, which is like this much. And then all of a sudden the interest only is over and your payment's that much. And it forced everyone to have to refinance. And then millions refinanced at the same time. And the whole world just crashed. It just,
yeah.
And it's like, Yeah, nowadays, you got to be careful thinking ahead on these
Yeah.
term loans. Like, what are you actually going to do in 3 years? Like, do you have the money? Do you not have the money? Can you roll it over? Can you switch it? Well, like, what can you actually do? Because I think if nothing, that market, I hope it taught people to like look a little bit further ahead instead of look at this cheap mortgage payment today that ended up blowing up the market 3 years later.
Yeah. Granted, people have a lot more equity these days than they did back because you're talking about the 125% loans. Like those don't exist anymore, right? So there is a little bit of a limiting factor there. But the last 3, 4 years have created a lot of new people entering into the market, new investors entering into the market. The Airbnb craze, short-term rental craze was here and gone, right?
Yeah,
That
that's like
create,
already kind of like,
yeah. Exactly. And that market already kind of crashed, right? People were losing 50%, 60% on the houses that they bought for short-term rental because they bought it at premiums. So in terms of like equity position wise, like the majority of the market has more equity. So I don't think we'll see that crash that we saw in 2008 of everyone selling at the same time. But at the same time, there are going to be a lot of distressed opportunities, and that's what we're already seeing right now, right? People are selling. Anyone selling right now either has to sell or is, there's one of two classes. They're either not a serious seller, right? Because there's people testing the market, or they have to sell. So you either fall in one of those two classes. It's no longer like oh, I'm a logical seller that's going to be going into the market expecting a logical price back based on the market conditions. It's not that anymore. It's you're either needing to sell or you are not a serious seller at all. So if you're not a serious seller at all and you're living back 3 years ago in terms of prices or 4 years ago in terms of prices, you're sitting on the market for 120, 180, 365 days. But if you have to sell, like that right there is, I think, right now where a lot of investors, if you're not scared of buying, a lot of our clients are finding good deals in that distressed market because they have to sell. And I think that's where the money is right now. We are probably going to have a hard time finding, I think, over the next 10 to 20, 30 years. I'm sure you might agree that has a buying opportunity to like, in the next 10 to 20, 30 years of what it is right now because inflation is up and it's going to continue to go up.
yeah.
So unless you're in hard assets like real estate and even Bitcoin these days, it's more tied towards the stock market than it's ever been, right? In terms of buying and selling. So it's like the only thing that you can really touch, feel, live in, rent out, write off is really real estate,
Yeah.
right?
No, I agree with you.
So right now, like the market itself is, I think, positioning itself to weed out anyone that's not a smart investor, and it's going to be driven more towards smarter investors. Because imagine if the rates actually did fall, right? Imagine if they do fall from where they are, because right now we're still writing loans actually at like 5.875, 6%. So sorry,
What is the interest rate today?
we're still writing them at 5.875 to 6%.
Not
with
bad.
like with like 20, 25% down, right? Very small buy downs, like it's still there. Um, but if we're looking at the 10-year treasury chart again right now, like if we were in the same market we were in last year or the year before, rates would be in the sevens and eights. I think that's where people have that short term. Consumers have very short term memory, right? Of bad news. They don't remember the sevens and eights that we were in before. And they're only thinking about right now where they saw a glimpse these past, few months of, oh, it touched 5.5, it touched 5.75, it touched 6%. Like that's it. But now everything else is average sitting above 6% at 6.5, 6.75. So
I don't even think that that's really a super high interest rate
it's not.
because so whenever I was first investing and I was just rehabbing like one or two houses at a time, I had to borrow hard money. And back then, I'm talking 25 years ago, hard money interest rates were like 15% and 3 points.
That's crazy because now Yeah, and now it's more like 8 or 9%, on average is the hard money side. Like we're writing a lot of debt for a lot of our fix and flip clients that are higher tier and like 8-ish%, 8.5-ish%, highest 9%. And like now the margins, I think just margins have slimmed. And because of that, rates are not as high right now than they should be. And again, that's what creates, I think, a perfect buying opportunity for a lot of investors that are entering into the market or trying to expand their portfolio right now. They're going to get seller credits 100%,
Yeah.
right? They're going to get contingencies that they want in terms of timeframes. They're going to be able to buy down the rate, right? Using those seller credits further than they've been able to buy down in the past. And if you buy down a 30-year fixed loan, as long as the property is creating cash flow, you can hold it for however long you need, right? The market out. And then if market decides to drop rates 4%, 3%, like which again, if that happens in our lifetime again, that really means that we have other things to worry about, right? Like our livelihood to really worry about.
I do.
Yeah, because rates only really like mortgage rates only really drop when it's bad news, right? Bad news creates lower mortgage rates. The federal funds reserve rate, which is what a lot of people have a hard time discerning between, when the feds get up there on TV and start talking about we're cutting rates 0.25%, that doesn't mean that mortgage rates are going to be cut 0.25%.
Yeah.
That 0.25% cut and every cut that's going to potentially happen in the future has already been priced into today's rates. So what they're talking about is overnight bank-to-bank lending rates.
Okay.
That is short term.
Hey, time for a 2-second public announcement. How would you like to have a 45-minute strategy session with me personally, and we can sit down and discuss, and no strings attached, what your real estate investing career can look like in 26 as we stack gold bricks in 26? Go to Dwanderful, DWANDERFUL, Dwanderful.com. Take my real estate investing quiz. Schedule a 45-minute strategy session with me personally, and let's see what we can do to get you going on the right track. Now, back to the show. If someone hears you on the podcast today and they call you up like, hey, Jonathan, I heard you over there at Dwanderful, and they call you up for the first time, give me like 3 actionable tips. Like, what would be the first 3 things they would have to do to secure a loan or to actually open the door to come in and say, hey, I've got some real estate, I need some money. Give me the first 3 things they'd have to do to work with you.
Are we talking about a buyer or a person trying to refinance?
Let's just talk about an investor.
An investor that's trying to buy.
That's trying to buy. Let's do an investor trying to buy.
Okay. So first and foremost, I would say have reserves, have liquidity, right?
Perhaps some capital.
Yep. So what that means is not just enough for 15, 20, 25% down, right? I mean, have 20% down or 25% down, plus have reserves for just in case something goes wrong in the investor sense, right? I'm gonna act as if this is a newer investor coming in.
Right. So we're new. They will.
Yeah.
I want to be an investor.
Yeah.
For Jonathan and Dwan. He's gonna fund me.
Yeah. So have the investment liquidity, right? To make sure you have at least 6 months of payments to go forward if something goes wrong and you lose a tenant or have to do turnover or whatever, right? So have that liquidity set aside. Do not put everything you have into one property, right? All the cash you have into one property. 2, I'd probably say be ready to spend money. And what I mean by that is invest in the property. You're going to have repairs that need to be done. You're going to have maintenance that needs to be done. You're going to have improvements that need to be made, right, to the property to make it more palatable for the market to rent out.
Okay.
Have that done, right? Be ready to spend on that. Get contractor quotes. Get an idea of what it'll cost to get the property to a position for it to rent out well. Because another problem that's happening in the market right now, and I'm sure a lot of people have talked to you about it and you've seen it, it's harder to rent a property out right now in general. Yeah. You're no longer, unless you're in like a very, very hot market and it's very specific markets, you're not getting top dollar long-term rents anymore.
Yeah.
Right? You're having to discount a little bit. You're having to give a month free. You're having to do, give certain appliances, this and that, right? So be prepared for that. It's more so what it is. Talk to a real estate agent. Talk to Dawn. Ask her about what it'll take to get the property up and running, right? So be ready to spend on that, right? And then the third thing I would say is, and probably these are all, I think, equally as important going in, is make sure the numbers work, right? And what I mean by that is make sure you're not buying above market. Make sure you're trying to buy below market as much as possible.
Yeah.
And make sure that the monthly payment is not just breaking even flat. Make sure you're getting a little bit of extra cash flow, 25%, 30% above the payment, so that that can go towards all your actual reserves that are needed to maintain the property. So 2 and 3 kind of go hand in hand, but also, this is about prepping to buy. And I think that those 3 are probably the most important points for a new buyer.
No, I agree. I think those are all really good tips. One thing I also like, if I'm wholesaling, let's say a house to person and they're going to rehab it. One thing I always want to know too is like, who's actually going to rehab it? Are you personally going to go on the weekends after you worked all week and rehab this house and, be like a weekend warrior? Or do you have contractors? Do you have rates? Do you have people that can do the work for you? Like, what are you doing? Because so many people like buy houses, they've got the money, they have everything, and they start rehabbing it because they want to do it themselves.
Yeah.
Work the first weekend and they work the second weekend, which is now like, 15, 16 days straight from their job. And then they're tired. They don't want to go on a Sunday. And then 2 or 3 weeks go by and they don't work on the property. And next thing you know, they're trying to get out from underneath it because they weren't prepared all the way.
Yeah, absolutely.
You say number 2 about having the money ready and to spend and to go into it. I think that's really true because they always go over budget and they always take longer than you think.
Yep. 100% every time.
So you got to add like 3 months and add like whatever money you have.
Yeah.
25% more. And if those numbers work, I think you're all right.
Yeah, 100%. I think that's very sound advice. Especially right now where inflation affects everything, right? So you could be in the middle of the project and you could start, or you can even be starting a project. You expect the budget to be 100,000, and because the war started, all of a sudden everything's more expensive. Like you could be looking at $110,000, $120,000, $130,000 budget now, just purely because of inflation and also the cost of labor, right? Just across the country. So that's all like definitely 100%. So that's why I'd say like you have to buy the property below margin, right? Below the market. You have to have like a 20% buffer, 30% buffer of at least the ARV. Don't buy too close to what it's supposed to be, because if you do that, you're just eating into your room and your equity, which is essentially supposed to be your cash, but it's going to very quickly not become your cash if the project goes sideways.
Oh, yeah.
Yeah.
No, I've had so many conversations like this with people. It's like, and like, I can even think back, like, I remember in COVID, the price of plywood, like, doubled.
Yeah.
It's like, okay, if you're like a home builder and you're building houses from scratch,
Yep.
you need, 500 pieces of plywood, and it just doubled in price. Like, where do you add that in?
Yeah.
It's just went up so much. It's like, oh my God, how are they charging so much money for everything now?
Yeah. And it's real. So I think that it's very important, like you said, to just have that money aside and be ready. I usually, and even for primary home buyers, I really try to do my best to tell them not to do too low of a down payment. I know it exists. I know 0% down VA loans exist. I know 3.5% down FHA, 3% conventional. It all sounds great until the market is in a downturn. Because if you look at a market in a downturn, that 3.5%, 3%, 0%, you're underwater very, very quick.
Yeah.
And all of a sudden, now you are 110% on LTV, right? And then if you go to try to sell, you have to put money in to sell it.
Yeah.
Right. And that's money you don't have. And also when you're buying a property, like people always forget, maintenance is expensive in general, whether it's an investment property or a primary. Maintenance is expensive. Then you have taxes, you have insurance, you have supplemental tax bills that pop up, right? Out of nowhere, right? You get a school tax that's all of a sudden increased. They say you got to pay $200 bill or $1,000 bill. If you don't have that money readily available, guess what? You're going to get penalties on penalties on penalties, and then it's going to they're going to put a lien on it. Like there's a lot of different things that can go wrong. So don't buy just because it's cheap, right? Don't buy just because you can buy it with a little percent, little down payment. Really try to do the math in terms of what's my trajectory here? What's the long-term plan? Don't look at the next year. Don't look at the next 3 years. You got to look at least 5 to 10 years, right? 5, I would say, is even like pushing it. Realistically, you'd probably want to look 7 to 10 years and make sure that you're going to have the trajectory and the liquidity to go that forward, right? And a big part of this that is really real world example is all the people in NorCal, San Francisco, and those places that worked at tech companies, right? Silicon Valley as well. But all those tech companies and such, a lot of those guys and girls were making 400, 500, $1 million. And all of a sudden they get laid off because AI is so good.
I know.
Right. And
have you ever been to like Tennessee and Texas and places like that? It's like, good Lord.
yeah. But if you look at those examples, that's a real world example of like, you really don't know what'll happen overnight. You really don't know what'll happen in a year, 2 years, 3 years, right? Because a lot of these people bought homes a year, 3 years ago, thinking, it's okay, right? I'm going to have a job. They're never going to lay me off. I make so much money. It's fine. But it's never guaranteed. And unfortunately, something like this rolls out, they lose their job. Now it's hard to get a new loan to buy something, and it's hard to refinance because you don't have the income coming in anymore. So a lot of those people are having to sell their houses.
Yeah. Oh, wow.
Yeah. So it's like if you ever get to that point, you don't want to be like, you want to have equity in there to make sure that you can actually sell and get money back versus sell and put money in.
No, I'm with you. I mean, my parents were probably the last generation of people that really could like work in a factory and like work for the man and retire and whatever. And there's different people in my age group. I'm 67, so there's still people in my age group that have like worked at factories and things like that. But for any generation down, like the man isn't something you can rely on. You have to rely on yourself. That's why I tell people, become a real estate investor. People always have to have that place to live. People have to have food. They have to have clothing. They have to have a roof. Buy in real estate, invest in real estate, put your money into it. And once you get everything done and paid way down, if the market goes up or down, it doesn't make any difference to you. And it's like you said, it's like a tangible thing. So I am always, for 35 years, I've been investing and I've been preaching to people, become an investor. Now they can get money from you. So if I teach them and you give them the money, it's the perfect world.
Done. Game over.
Done.
Yeah.
I want to ask you a personal question.
Sure.
What is your favorite band of all time?
My favorite band, musical band?
Yeah.
Okay. I grew up on Linkin Park. So there's a very, very old, not old, but like they don't exist anymore as big, I think. They lost a few members, but yeah, I grew up on their more rock style music.
How old are you? Are you in your 30s?
I'm 32.
Okay.
Yeah.
My kids love Linkin Park and they're all in their 30s. And I like it too. Like whatever they listen to, I always like too. So
Yeah. But I don't listen to them much anymore. These days I've transitioned more to just listening to podcasts and different people. I think it's just knowledge is becoming more important than I think music, right? So investing in that, I think time-wise, because we're so limited back in the day. Like when you're younger, you can always listen to music and you have time to do everything else. These days, you don't have time. So, yeah, I think knowledge is more important. So I've just been listening to more podcasts and just news in terms of like markets, financial markets, how everything's moving. Because everyone turns to me and asks me, hey, I know you don't have a crystal ball, but where are rates going tomorrow? Like that's the question I get all the time. So I have to be
say what the rates are.
I have to be ready. Yeah, I have to be ready to prepare, to answer all those questions.
Well, Linkin Park's a good choice. I feel like you can always tell a lot about people by the kind of music that they listen to. What's your favorite food?
My favorite food is Korean food. Yeah.
I like my favorite actual food is sushi.
Oh, okay.
I had one thing for life, I'd eat sushi.
Oh, that's amazing.
I don't know, maybe India, no. I like them equally as well.
Yeah.
Well, what is your next big goal with your company? What's your next big goal And how can the Dwanderful world help you reach that goal?
We are really investing a lot of time, energy, and money into transitioning more towards a tech stack. So
Okay.
the industry itself is very archaic. And especially when you're talking about not the conventional world, but the non-conventional world, is even more archaic. People are still working through emails, people are still working through, document reading manuals, right? So we are trying to create a new path away from that and have, AI make everything more efficient to close loans quicker, right?
Mhm.
And remove human errors because that's always super frustrating. But then also be able to have a human touch to it, which I think is lacking. When you make everything AI, and people tell me this all the time, they try to pick up a call to call someone, and then you talk to an AI agent. You say, speak to an agent. They said, in order to help you further, please specify your, and you're like, okay, well, this is my situation. And they go, sorry, we don't understand that. Like, that's kind of the loop. It's the death loop that happens right now from AI.
Yeah,
Yeah, exactly. But sometimes like they don't even allow you to go agent, 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 agent because they said, please specify, please specify, please specify, right? And so we're trying to find a fine line in between, the robot world of AI and then the human world of human touch and make it as comfortable as possible for consumers and borrowers to go through the process, especially in the investing world because
the price tag because even like in the investing world, people are going to build relationships with you.
yeah,
They're
exactly.
going for Convoy House because you have you, they like you. They're like, hey, I like
Yeah.
Jonathan, he's really great. And they're going to build a relationship with you. And yeah, the computer can do a lot of it, but those personal relationships, I think they still have to be built.
Absolutely. Yeah, and that's kind of our focus. So keeping the personal touch, but still having the efficiency of AI and
Okay, so how can we help you reach that goal? Just send
uh,
one of you to borrow.
yeah, come through. Go to convoyhomeloans.com and let us know you came from the show and definitely reach out to us in any form or shape of way. You could download our app on the Google App Store or Apple
I'm
App
going to
Store
download
as
the
well.
app today.
Yeah, for sure. Yeah, and you can create an account, and if you need anything, you can send requests through there. Like, we built out an app to really be consumer and borrower friendly to try to create more ways of communication, and just to be able to keep the line of communication open because I think that's where a lot of investors lack, right? They always go for the cheapest product. They always try to work with the cheapest company, cheapest this, and then what they realize is, oh, that also means I'm getting the cheapest service. That means that if I need
Yes, and
something,
not bad.
yeah, if I need something at 8 p.m. on a Friday, that person is not responding to me, right? That company's not responding. The bank's not responding to me, right? They'll say, wait till the next business day. So it's stuff like that we're trying to fill a hole in and really trying to cater to the investors, cater to the clients, because investment real estate happens so quickly, right? Especially the good deals, they happen very, very quickly. Once you get a hold of one, you have to make a decision within a day, within hours.
Yeah.
Like, do I want this or am I dropping this? Right?
Yeah,
It so in order to do that,
work with me. We have a like an app inside of my network called Team Dwanderful. And I'm like, listen, if you come across a deal on a Saturday and you got to ask a question, just text your question and I'll get back to you. Because I know you could be sitting with a homeowner that's
yeah.
wanting to sell some house so that you've got questions and everybody else in the world's closed or they're automated and you need help like then.
Yep. And now you have another source. We'll do the same thing. Yeah.
Yeah, so I like to people like that. It's one of the reasons that they like to work with me is because and like in the group chat, like it's me, my husband, my son, my daughter. We all invest.
Oh, I love that.
I will answer somebody within a few minutes because some people really are sitting or at a closing table and something's not right with the documents and they need help. And I'm like, got you, man.
Yeah,
Like,
exactly.
we're not in a. I don't feel like we're in a 9 to 5 world anymore.
No, we're not. We're not. I think entrepreneurship was probably the way and the best way for normal people. And I don't want to say normal in a bad way, but like if you're a W-2 employee working 9 to 5, like the best way to become entrepreneurial is to invest in real estate.
Exactly.
Because then you're building something, you're building equity, you can borrow against it, you can depreciate it. Like there's so many benefits to real estate. That's my number one passion is that. Yeah.
Okay, so there you go, dwanderful.com. Opt in, take my quiz, and have a conversation with me. And then I'm going to send you over here to
100%.
Okay.
Yep.
Last thing is I want you to give us a word of wisdom, but just one single word.
One single word. It's also the single word that I struggle with most is patience.
Ooh. Are you that person that's like, Lord, I want patience. I want now.
No, I know if I don't, I'm careful with praying for patience because I know God will give me opportunities to be patient, not actual patience. So,
That's
so I'm careful.
like, I want patience. I want it now. And I laugh and say, okay, just know you're going to
Yeah.
get your way. That's going to teach you patience.
Yeah. So I really try not to pray
I have
for
to
it.
keep relearning a lot.
Yeah. Yeah. I try not to pay for it, but it's something that I struggle with most because, I run a business. I have staff of like 50 people now. We do a little over like a billion something a year, right? And we have done that for the last few years. So for us now, I want things to move a lot faster than they actually are, right? And I want everyone to have a good experience with us. I want all of my people to be on board, but unfortunately, employees sometimes and a lot of times will never care as much as the owners, right?
Yeah,
So we're always in the tug and pull of how much can we actually push them and encourage them to grow because it'll be good for them to grow, but then also at the same time take a step back and say, okay, I can't push as hard because they need their day off. Like they have to have their day off. This isn't they're not an owner, right? So they don't have to be 24/7. They need the ability to be able to clock out and relax a little bit. They can't keep going. So
exactly. Nothing, and nobody hate on me for this, but like this age group of like the Gen Z,
yeah.
I have, so my husband and I are basically rehabbing an entire town in Iowa.
Wow.
In the town, I opened up an antique store, a boutique, clothing boutique, and a little coffee shop. And I'll get these like 20-year-old girls and they'll just be like, oh, I need the day off on whatever. Go, the schedule says this. And then they'll just go, okay. And they'll just send me a text and say I quit. Like, did you just text me that you quit?
Yeah.
Seriously? Well,
Yeah.
not this or that. If I have to work this hour down and I don't want to, I'm just going to quit. I'm just like, who does that? Like, if I would have done that, my dad would have killed me.
Yeah.
Quit.
Yeah.
So I have to learn a little more patience with this younger generation. My investors are all like, they're all good because they're in it to win it. They want to become an investor. But for my little personal stores that I have, I'm just like, Lord, help me.
Yeah.
Okay. So patience. So what people do that listen to the podcast is every week we have a word of the week from the guest. And I tell them to write the word on a little sticky and put it on their bathroom. And when they're brushing their teeth or whatever, just say patience, 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 patience. So I actually just told you what patience means to me, but what does patience mean to you? Like,
To
what does
me,
that word mean to you?
yeah. It's I think for everything going is so fast in my life, right? Especially as a business owner, especially at the volume that we produce. We're not a massive shop, but we're not a small shop. So I'm kind of in that awkward medium. So, but I want to be bigger, right? I know there's greater plans ahead and there's greater things that we want to achieve. But it's just a reminder to myself to always just stay grounded still, try to enjoy the process. And then, eventually we're going to get there. But I need to have a little bit more patience of not jumping ahead of myself and trying to grasp at something that isn't ready for me, right? Because the door will open when it's...
You really meant to.
Yeah.
Being trying to do too much can end up being out of business,
Exactly.
To grow too fast. Okay, so I like that.
Yeah.
I like that. So everyone, that's our word of the week is patient. But we're going to learn how to have patience. Well, I want to thank you so much for being on today, Jonathan. You are just delightful.
Thank you so much, Dwan. I loved it.
Tell everybody real quick one more time, how do the fastest way to find you?
Go to convoyhomeloans.com and let us know you came from the show.
Hey, that's easy enough. Convoyhomeloans.com. All right, everybody, we will be back next week. Oh, also, do me a favor. If you enjoyed today's show, I want you to subscribe and like and follow and all the things. Leave a 5-star review and write something. Just write like a sentence about how delightful we were. And just keep tuning in every month. We're in our 8th season. So we're in our 8th season. We're just about ready to crack 2 million downloads. So, I mean, we're like right there. So this show could put it over the edge. This could
Let's do it.
So like every show right now, it's like, okay, one of these shows is going to be the one that's going to put me over the 2 million. So it might be you. I think
I hope.
it'll be you.
I hope so. I hope so.
That would be so fun, would it?
Yeah.
So we'll be back next week, same bat time, same bat channel. And remember that the truth is in the red letter. All right, everybody. Ciao.
Thank you.
Hey, folks, thanks for tuning in to the most wonderful real estate podcast ever. Don't forget to go to Dwanderful.com, take the quiz, schedule a strategy session, watch all the podcasts, and be a part of this year. This is a really important year. We're stacking bricks in 26, and I want to help you stack as many gold bricks as you possibly can. That's only going to happen if you subscribe, leave 5-star reviews, stay tuned, share, and just let everybody know about the wonderful world of Dwanderful. And I'll see you next week.